Investment styles are consistent and rigorous approaches to investing. They make investing decisions based on a set of criteria or a topic. Investing approaches might assist you in becoming more methodical and disciplined in your investing. You may also track and compare the performance of your investments. Without a strategy, it's difficult to set investment goals, let alone determine if you're meeting them. Before we go into the most common investment approaches, it's vital to review some broad investing principles. To begin with, even if you are frightened of losing money, you should never rush into an investment. Making rash investments almost usually ends in disaster. Smart investments are rarely rushed into or discussed by everyone. Second, stick to what you're familiar with. If you don't understand an investment strategy, you should either avoid it or learn more about it. Investing in stocks is similar. Avoid organizations whose business models you are unfamiliar with. 1. Long-term investment. The most fundamental long-term investment approach is to buy and hold. Individual stocks are simply bought and held for an indefinite amount of time. Obviously, the companies in a buy and hold portfolio determine its performance. Buy and hold, although being the most basic of investment strategies, can be more effective than one might imagine. Frequently, investors are their own worst enemies, selling equities at unsuitable moments. This solution, however, solves the problem. A buy and hold portfolio can be greatly enhanced in two ways. To begin, seek out stocks that will last a long period. Buying stocks with a strong brand that are unlikely to be disrupted is an excellent idea. Second, keep the number of places as low as possible. That way, any negative picks won't have a significant impact on your portfolio. And the stocks in your portfolio that perform well will grow into large positions. 2. Investment in expansion. The greatest advantage of growth investment techniques is that they expose you to the fastest growing sectors and businesses. This means you're investing in companies that have the best likelihood of delivering large annual returns. Growth stock investing is particularly appealing since it allows you to learn about firms that are innovating and changing the future. In contrast, growth investing should be treated with prudence. Growth stocks typically have the highest market valuations. They must live up to market expectations to justify their valuations, or the stock price will drop, frequently substantially. If you want to invest in growth stocks, do your homework and avoid chasing firms merely on the basis of sentiment. 3. Momentum investment. Movement investment is similar to growth investing in that it looks at the stock's price momentum rather than profits or sales growth. Statistics show that the best performing equities in a certain era have a high probability of outperforming in following ones. Thus, price action is utilized solely to make purchasing and selling decisions, albeit it does aid in avoiding small and illiquid companies. A simple momentum strategy would hold 10 to 20 of the best performing equities for a year. At this moment, all stocks are sold and the process is repeated. More advanced iterations of the technique will continuously rotate funds into the stock with the highest momentum on a monthly or quarterly basis. Momentum investment provides positive returns most of the time, but it can also produce substantial losses. Other tactics should be employed alongside momentum investment strategies. 4. Value investment. Value investment has provided the most consistent long-term returns over the last century. Warren Buffett made his fortune by investing in companies that generated consistent profits at reasonable prices. Value investors buy stocks that are trading at or below their intrinsic or fair value. This provides a safety net in case something unforeseen occurs. The lower the stock's acquisition price, the less the corporation must earn in the future to produce a reasonable return. Value investors must understand financial statements in order to determine a company's true worth. The majority of low-cost equities are priced that way for a reason. A value investor's goal is to find high-quality, low-cost stocks. 5. Small-cap stock investing. Focusing on smaller enterprises provides two benefits. To begin with, it is easier for a small business to increase its earnings. It is far easier to double income from a starting point of $100 million than it is from a starting point of $10 billion. Second, smaller companies are more likely to be overlooked by investors, causing their stock price to fall. As the company expands, other investors will take notice, and the discount will lessen. If you are an early investment, you may benefit from a bigger return. There are a few disadvantages to investing in small-cap stocks. It will be more difficult to obtain information, and you will have to commit more time to investigate. Small enterprises are also less liquid, with volatile stock prices. You must carefully manage risk and avoid situations in which your liquidity runs out before you can exit. 6. Investing in dividends. Dividend investing, also known as income investing or yield investing, seeks to generate a consistent stream of income. High dividend-yielding stocks are typically profitable, but their growth rates are modest. As a dividend investor, it is your responsibility to choose companies with a high yield that will be able to continue paying dividends in the future. It would be even better if the firm could increase its dividend yield. Dividend investment strategies are about more than just making money. If dividends are reinvested, yield portfolio can experience large capital growth. Dividend-paying corporations are frequently profitable, which makes them defensive during downturns. 7. Investing in environmental, social, and governance (ESG). ESG investing considers how environmental, social, and governance factors influence a company's long-term value. According to the argument, companies that take governance and the environment seriously are more likely to flourish. ESG investing includes SRI, socially responsible investing, impact investing, and ethical investment strategies. These policies, on the other hand, seek to limit the way capital is deployed. ESG investing investigates the effect of similar issues on returns. Individual investors can purchase ESG funds or select equities using ESG grading services. The discipline is still in its infancy, and the effectiveness of these approaches has yet to be shown. It's a good idea to do some research before investing in a fund or signing up for a rating service. 8. Investing in factors. Factor investing is a strategy of selecting stocks based on facts. Investment factors are stock characteristics that have been proved to outperform over long periods of time. Among the most commonly used attributes are value, growth, market value, and momentum. Two other important characteristics cited are volatility and quality. In factor investing, these notions are condensed to quantitative criteria. Several quantitative investment firms have launched ETFs, exchange-traded funds, that index stocks using factors. Using these items, advisors and even individual investors can design portfolios based on empirical facts rather than philosophy. 9th, passive investment. Indexing, often known as passive investing, is a sort of long-term investment. Indices are preferred over individual stocks. This approach offers several advantages. To begin, investing in market cap-weighted indexes suggests that you will be placing your money into the stock market's fastest-growing large-cap companies. This eliminates the need to select stocks and ensures that you have all of the important ones. ETFs, which offer lower expenses than other products, are the most common method to proceed with passive investing. A single transaction commission allows you to hold dozens, if not hundreds, of stocks. According to studies, most actively managed mutual funds do not outperform their benchmark. By investing in passive ETFs, you may monitor the benchmark while simultaneously saving money. The money saved on fees accumulates in the same way that compound interest does. This factor alone can result in much higher long-term returns. Passive investment strategies, such as the buy and hold strategy, prevent investors from ruining their gains by selling at the wrong time. 10. The core/satellite strategy. The core satellite investing technique combines passive and active investing methodologies, a basic portfolio of ETFs, as well as a few actively managed equities is held. This enables a fund manager or investor to profit from unusual opportunities that index funds might miss. Individual stocks, for example, can be purchased or sold when values are high, and excellent smaller companies can be invested in. Passive funds make up around 70% of core satellite/portfolio allocations, while active strategies make up the remaining 30%. Any of the above-mentioned approaches can be used to allocate the fund's active portion. Another consideration is how much time you have available. It takes a long time to conduct the necessary research for value, growth, and small-cap investment. Momentum and passive investing, on the other hand, require less time. Finally, you should consider your risk tolerance. This is related to both your financial situation and your personality. If a volatile investment is keeping you awake at night, passive investing or a portfolio with a broad asset allocation will be more suited. As an investor, you have a size and flexibility advantage. You can take advantage of this advantage by combining one or more of these investment tactics to develop your own distinctive strategy. I hope you got some valuable information, and let us know in the comment what type of investment you're going to start. Make sure to like, subscribe, and turn on bell notification for more content like this. Thanks for watching.